Thank you all for coming. Really appreciate you coming out tonight to hear about commercial real estate finance. My name is Jamie Woodwell. I'm with the Mortgage Bankers Association. We are the association for the real estate finance industry across both single-family, commercial, multifamily parts of the industry. But the reason we're here tonight is to talk about commercial real estate finance. So just to make sure we're all in the right place, this is the Commercial Real Estate Finance, or CREF, Career Forum. We're going to be talking about the $2.4 trillion commercial real estate finance industry and about internships, jobs, and careers in that industry. So if you're looking for a biochem course or something else, that's not here. We've got three great panels tonight. The first is a leaders panel, where we're going to have industry leaders talking about the industry and about the growth that it's seeing right now. We're going to have a colleagues panel where your future colleagues will share their experiences, what they've seen in the industry. And we're going to have a recruiters panel where recruiters are going to provide information and tips on internships, jobs, and careers in the industry. Before we dive into the panels, what I'd like to do is just first recognize the 12 commercial real estate finance firms that sponsored this event and made it possible. We've got Arbor Commercial Mortgage, Berkadia, Berkeley Point Capital, CBRE, HFF, KeyBank Real Estate Capital, Northmark Capital, PNC, Prudential Mortgage Capital, Red Mortgage Capital, Walker & Dunlop, and Wells Fargo. And all of those companies are represented here tonight. There are folks from each of those companies, so please look for the name tags and talk to them about their companies, about the industry, about what they do in this space. And you'll be hearing more from folks about each one of those companies on the panels. Also want to recognize the schools and the professors who have made this event possible. At American University, we've got Peter Chinloy and Eric Bojak, pardon me. At Georgetown University, we've got Matt Seifer and Julia Newton. At George Mason University, Bob Wolf and John Crockett. At George Washington University, Tony Yeaser and Sandra Levitt. At Howard University, Bill Brent and Erica Smith. Johns Hopkins University, Chuck Schilke, and at the University of Maryland, Margaret McFarland. All of those folks were incredibly helpful in getting the word out and helping to shape the program. So really want to thank them for helping make this possible. And then from the Mortgage Bankers Association, two folks, Reggie Booker and Shay Jones, who really helped pull this program together. So now, to kick things off, what I want to do is introduce the person who's hosting us here this evening at McDonough School of Business, which is Matt Seifer. He's the Director of Real Estate Finance Initiative here at Georgetown's McDonough School of Business. Matt's a professor here. He's got deep experience in both the academic and the professional worlds, and he's been instrumental in making this event happen. So, Matt, thank you very much for hosting us here tonight.
All right, everybody, welcome. My name's Matt Seifer. I'm the Director of Real Estate Finance Initiative here at Georgetown. Thrilled that everybody's here. From a student perspective, I don't know if you paid attention when everybody was walking in, but there's like 35 recruiters here, or people associated with these companies. So I couldn't possibly be happier with the exposure your students are getting from an opportunity in an internship or job or whatever it might be. But just real quickly so we can move on, I just wanted to extend my thanks to the Mortgage Bankers Association. This is a really tremendous opportunity for our students. And to be honest with you, when I was going through graduate school, I never sat through one career fair in real estate because they just didn't exist. So the fact that we have this here, I think you guys are, and gals are really leaders in the space, so I appreciate that very much. As I sit here and listen, just over the years I've been in academics, and I've always listened to students really talk about real estate. And one of the things that they always say is, I'm interested in the asset class. The tangible nature of it is exciting to me, but I don't really understand where I fit. And the beauty of this event this evening is you have half of the real estate capital markets here in front of you from the debt perspective. And it's a great opportunity for you to really start to place where you fit within the broader capital markets. And so I think it's really a tremendous opportunity that I think is very unique. And we're obviously very proud to be hosting it here at Georgetown. So appreciate the students coming, the faculty, and the MBA, of course, as well. So with no further ado, I'd like to introduce the moderator of the first panel, E.J. Burke. E.J. is the Executive Vice President and the Group Head at KeyBank in their Real Estate Capital Group. He assumed the role in 2005, so he effectively shepherded that group through the entirety of the Great Recession, so I'm sure there's a lot to talk about there that would be interesting. Throughout his time at Key, he was responsible for the off-balance sheet capital markets and activities including the mezzanine, equity, commercial mortgage-backed securities, agency, and life co-products. EJ also serves on the board of directors of the Mortgage Bankers Association, and if I'm not mistaken, you are the incoming chairman of that group. So with that, EJ, the floor is yours, and look forward to the evening. So thank you very much.
Well, thank you for the introduction, and I might say that on the way over here, I thought about our panel, and I could safely say I'm probably the only one that on this panel that made some terrible mistakes leading up to the financial crisis. So we have a panel here tonight that is representative of a lot of multifamily lenders, some life company lenders, a really great cross-section of our industry. And what I'd like to do is ask our panelists to come sit down, and then I'll introduce you. The format tonight that we've talked about, we have some, what we're going to do is each panelist is going to talk a little bit about who they are, what their firm does, and a little bit about their background. We have some questions we're going to ask them, which we think will help you a little bit when you talk about, or when you think about commercial real estate as a career. But by the same token, if you have a question, a comment that you'd like to ask the panel, please raise your hand. We'll call on you. We'd like to make it as interactive as possible, so you don't have well, not everybody has gray hair, but a bunch of gray-haired people talking at you. To my immediate left is Nancy Farrell, and she's with Northmark. Next to Nancy is Jeff Majeski. Jeff is with CBRE. Next to Jeff is Jeff Day. And next to Jeff Day is Patty Farrell. We have two Farrells, but one with an A and one with an E. You'll have to guess which one that is. And then Dan Cunningham is to Patty's immediate left. And then last but not least, the legendary Mike McRoberts with Prudential. So what I'd like to do first is, Nancy, tell us a little bit about yourself and your company, what you do every day, and what your background is.
I'm Nancy Farrell. I am a Senior VP and Managing Director in the Baltimore office of Northmark Capital. Graduated from the University of Delaware with a major in finance. And I'll give you a little background on Northmark. We are the largest privately held commercial mortgage banking company in the country. We are based in Minneapolis, headquartered in Minneapolis, and have 33 offices across the country. Our owners are the Pollard family, more famous for owning the Minnesota Twins, so that you can relate to, I'm sure. And we place debt, equity, and across the country with life insurance companies, CMBS, which are conduit Wall Street lenders, and also Freddie Mac, Fannie Mae, and HUD. We service for most all of our lenders. Our servicing group is also headquartered in Minneapolis, and right now we service about $42 billion of debt. And we have, with our 33 offices, we cover obviously the entire company, or the entire country. And we'll get a little more into what we do in a future question.
Jeff?
I'm Jeff Majeski. I'm with CBRE. I'm the Senior Managing Director and Chief Operating Officer for our mortgage banking group. We are a line of business under the broad CBRE umbrella. And I would like to say that from our perspective, the finance group is the one that drives the rest of the businesses within CBRE, but I don't think anyone else agrees with me, except for maybe me. We're very comparable in size, Nancy, to your operation. I told Nancy earlier I was on a panel with one of her partners Friday, and we were talking about our firms, and we're in 33 offices, and we have about 120 producers. And it's interesting because there's a long history of our company in mortgage banking, and it actually starts in Minneapolis, back during the days of Larry Melody. So kind of looking at where we are now, we are a national company, 33 offices, 120 producers. We've done about $33 billion in originations over the last year and a half. And of that, we did the business with about 250 different capital sources. So we're hitting life insurance companies, banks, we're Freddie, Fannie, FHA. I mean, if there's a capital source in the U.S. and even international that wants to lend or invest in real estate, we're connecting with them at some point in time. Behind that 120 producers, there's a network of about 150 support people. And they're really more than support people, they're our partners. And these are the analysts, senior analysts, and the vice presidents that work closely with our producers, which, as we go through the panel, we'll add a little bit more color about that position, because those are the ones that we're here to tell you about the great career that you can have in mortgage banking.
Thanks, Jeff. Jeff?
Thank you, EJ. We tried to make this easy for you by duplicating names as much as we could.
Yeah.
My name is Jeff Day. I'm the Chief Executive Officer of Berkeley Point Capital. Berkeley Point Capital specializes a little bit more specifically on one area, which is affordable housing. We have about $30 billion in assets under management, and we originate mortgages almost exclusively through Fannie Mae, Freddie Mac, and FHA. One of the more interesting aspects of our platform is that we used to be a business unit of Deutsche Bank, and along with two partners whose names I think you might recognize, one is Lou Ranieri, who was the inventor of the mortgage-backed security, and for those of you that have read Liar's Poker, is featured prominently in the book, sometimes not so favorably, and amazingly enough, and you really need to read the book if you haven't already, he's not that much different now than he was when he was on the desk at Solomon, which is pretty funny. When he's not mad at me. When he's mad at me, it's less funny. And our other partner is Wilbur Ross, who was head of distressed investing at Rothschild, and he's now one of the largest private equity investors in the world. So it's been a very interesting ride since we acquired the company from Deutsche Bank in March of 2009. We have 225 people in 13 offices around the country. I think one of the most interesting aspects of the business and something that resonates with many people is that because of our focus on housing and originating mortgages through Fannie Mae, Freddie Mac, and FHA, we have a mission which is a focus on workforce housing. And over 95% of the units that we finance are occupied by tenants who are at or below area median income. So we provide, especially in distressed economic times, we think a very important source of capital to the marketplace that otherwise might not be available during certain parts of the cycle.
Hi, I'm Patty Farrell, and I'm the one with the A. I work with Wells Fargo. I am the chief underwriter and the manager of the underwriting platform located here in Bethesda. We are a platform that does about $8 billion a year in commercial real estate lending. I've been in the business about 25 years. I graduated from Salisbury University and have worked in legacy companies to Wells Fargo pretty much my career. I started with a small entrepreneurial group that worked with Fannie Mae that eventually was purchased by Wachovia, that was eventually purchased by Wells Fargo. The platform that I work for is the multifamily group. We are but a blip on Wells Fargo's screen of the business they do. My group is 35 people scattered across the country to support the origination network that's scattered across the country that does Fannie Mae, Freddie Mac. We do FHA business, and we do bank balance sheet business. We also have access to the Wells Fargo network of lending opportunities as well. So great industry, a lot of fun, and where I've made my career.
Good evening, everybody. My name is Daniel Cunningham, and the way that I answer what I do is the first question is when you fill out your tax forms, it asks for your occupation, and I put on that, and I've been putting on that for more than 25 years, real estate lender, because it encompasses all the different things that I have done. So my focus has been on the debt side of activities. I joined PNC about a year and a half ago, and I was brought in to take over the East Coast for originations for agency business. Agency business for us means the Fannie Mae, Freddie Mac, and we also do FHA. I am part of a corporation that has almost 60,000 employees. I'm part of a division, which is a real estate division, that has about 1,000 employees. And I'm part of a group, which is the multifamily group, that has about 500 employees. So we are scattered, we're diverse. When I took this job a year and a half ago, my 83-year-old father, who lives in Boston, and by the way, still works full-time, so you can keep that in mind, but he's not in real estate, he said, "What does PNC stand for?" And I said, well, it stands, a lot of you'll find in this industry, there are lots of acronyms that mean things, but also the acronyms have their own life. But PNC does stand for, originally for Pittsburgh National Corporation, and the company is based in Pittsburgh. So what does that mean for me, for what I do running the East Coast for agency business? My boss is in San Francisco. His boss is in Pittsburgh. His boss, who runs all of real estate, is in Pittsburgh, but she moved down from New York after commuting for several years. Her boss, who's the head of the bank, is in Pittsburgh, and he moved down actually many years ago from New York. So one thing that I would tell you is that you should look around to the people that are in the crowd next to you, because if you're thinking about going in the real estate business, you're going to want to get along with some of these people. I look around here, and EJ was talking about Farrell, and now you have Jeff and Jeff, and I used to work with Patty for many years at Wachovia, when it was Wachovia, and the other thing is lots of times, if you look at resumes of people with our years of tenure, we have lots of different, Patty called them legacy companies on them, because this has been a dynamic industry where there's been a lot of change. I used to work at Fannie Mae for running the affordable housing debt activities, so I had a lot of interaction with these people while Mike was at Freddie Mac back in the day. So everything, it really doesn't change all that much, and you really want to be comfortable with the industry. There's a lot going on, and I would also say as you change jobs, be very careful about what you say on the way out the door, because you may in fact be working for somebody the next month or the next year. So just be open to that, and it's a very fluid experience. My background is I have an undergraduate degree from Harvard. I worked in the public sector. I then went to the Sloan School at MIT to learn the language of business, which I did, and then I figured I'd work in the public sector for a couple years. Work in banking for a couple years and then get back to the public sector or nonprofits or something like that. So I haven't quite made it back yet, but I would say part of it is because the people that you work with and the substance of what you do is what makes you want to get up every day and have a good time at work.
Good evening, everybody. My name is Mike McRoberts. I am the Managing Director, Head of Agency Lending for Prudential Mortgage Capital. I've been with Pru almost 2 years. After, as Daniel said, I was with Freddie Mac for 20 years, so I have a lot of history and background in multifamily finance that I gained at Freddie Mac. Undergrad at James Madison University and graduate degree MBA at University of Georgia. Go Dogs if you watched the game on Saturday. Yeah, here's a dog right there. There's always one in the crowd, at least. I just want to take a second, kind of explain what Prudential is all about, because it's very different and unique from the other panelists here. Prudential is, you think of Prudential as a life insurance company, kind of a big investment institution, and that's what it is. It is purely an investment institution. So what they do is basically take insurance premiums and then other capital from other sources, pension funds and other life insurance companies that don't have a platform to invest in certain areas, and they take that money and they invest. And they invest in stocks and bonds and private equity and real estate equity, and then they also invest in mortgages. And there's a certain allocation to mortgages, and Prudential is one of the largest providers of commercial mortgage debt to the industry. We'll probably do about $9 billion of loans, mortgages on retail, industrial, office, multifamily, hotel, and other property types. In fact, Prudential is heavily involved in agricultural lending as well, and that's part of the real estate group. So you have that big Prudential's a big investment firm allocating a certain amount of capital to mortgages, and that's the group I work in, Prudential Mortgage Capital Corporation. And within that, we do all that lending for all those different income property types, but we also have agency lending responsibilities as well. So we work with, as most of the other panelists do, work with Fannie Mae and Freddie Mac, and that's what I do pretty much every day. I want to just expand a little bit on what Daniel was saying about in the industry. It's funny, I know all these people, and I've worked with all of them for decades. I feel old when I say that, but it really is a small industry. I am old, yeah, right, that's right. It really is gratifying to me to see, to just, there's somewhat of a random selection of people that got together, but we all have worked together in the industry as competitors who are working together to get things done for, again, over 2 decades. So it's kind of fun to be here with you all tonight.
Thanks, Mike. And my colleagues at KeyBank who are here tonight would be sorely disappointed if I didn't tell you about Key. We're a $90 billion bank. We operate in about 14 states. We have roughly 13,000 employees. In real estate, we are a national business, so we operate out of 22 offices inside our banking footprint, outside our banking footprint. We have 650 employees, but about 300 of them are in Overland Park, Kansas, because that is where our loan servicing group is. We're the 3rd largest commercial loan servicer in the United States today. Like a bank, like most banks, we lend money for our own account. We have about $12 billion of commitments today on our own books. That's down from $25 billion before the start of the financial crisis. But then we also provide, we have a broker-dealer, so we provide quite a bit of equity capital, high yield, public debt, typically to REITs. And then, like many of the panelists, we're a mortgage banker. We're a Fannie Mae DUS lender, Freddie Mac Program Plus, which are the 2 GSE multifamily programs. We also do some FHA work. We do some life company placement, and then we act as a principal, originating loans for securitization. So we have a fairly broad platform doing many of the things that the panelists do. So that's why we know each other so well, because we compete a great deal against each other. So that's my pitch. So we'd like to have a little conversation with the panelists. I'm going to kick it off with a question, but again, I want to remind you, if something comes to your mind that you want to ask one or more of the panelists, please raise your hand and we can call on you. So, Mike, I'm going to start with you because you were the last guy to talk. These young people could do anything. Why commercial real estate finance?
Well, I think it was mentioned earlier, I thought about that question. It's tangible. It's something you can touch, and that's what really attracted me to that. I actually got exposed to it. My father was a life insurance company lender, and I kind of followed in his footsteps. But, once I got into it, I really found that it was something that was really exciting to me, the tangible nature of it. I can go to a piece of commercial real estate and be in that property and think about all the things that are going on with that property. So who's the owner? Why is this operating? Why are people leasing here? If it's a multifamily property, why are people living here? Is a retail center, why is this the right location for that? Why is it convenient? Why do retailers want to locate themselves in that spot? So you think about all the dynamics of it. And I think a lot of people who aren't exposed to commercial real estate drive by office buildings, drive by shopping center, drive by apartment buildings, and don't really think about everything that's behind that. Who's the owner? Why are people there? Why is that going to live on for a long period of time? And what are the demand drivers? Why is that going to be a viable commercial real estate project? So I think you think about the industry, you think about the economy. There are a lot of factors that go into the success of a commercial real estate project. And to me, the more I got into it, the more I got exposed to it, the more I saw that it was very interesting. And I think there's a great exposure, a great balance of analytical thinking as well as kind of people involvement. And that's really what attracted me to real estate.
Nancy, you want to give us your view on that?
Yeah, I also I went the banking route after school, but my father was an architect, and so I went out on jobs occasionally. growing up and stuff. So I had some exposure to real estate and really had an interest in moving into real estate finance. But I think that real estate as a career, commercial real estate, offers a lot of options. I mean, you can be on the financing side, but you can be an analyst, you can be in the servicing side of a loan portfolio. You can be a leasing representative, you can be an owner. There's a lot of different options, and if you work in the industry, you're working with all of those types of people. I mean, when we take lenders out to look at a property, the leasing person's there, or the finance person's there. And so you really do, have exposure to a multifaceted piece of property. And the other thing I love is that you're working on all different types of property. You can definitely be a specialist in student housing or low-income housing tax credits or multifamily or whatever, but you can also deal with shopping centers and retail centers, all different types, office buildings, industrial buildings, and multifamily as well. So it's just interesting in that regard too. It never gets boring.
I'd like to add, and this was actually a conversation that I had at lunch today with a couple of our investment sales professionals, and Mike, it really touches upon what you had said, and Nancy, you as well, that when you're looking at an asset from a mortgage banking standpoint, from a finance standpoint, you get to know more about that asset and that owner than really anyone else that's touching the asset. Because if you look at the investment sales professional, they're going in, they're looking at the asset, and all they're thinking about is, what's the pro forma say to get the maximum price that I can get for the seller? The mortgage banker comes in, and we have to understand the operations of the property, how is it positioned in the marketplace, to what Mike had said, why are tenants here, why do people live in these apartments, and oh, by the way, from a capital standpoint, owner, how are you capitalized? Are you deep pocket, thin pocket, OPM, your money, how are you going to get there? And then you have to go to the lenders and say, this is a great deal because of all the knowledge you have about the asset. So really, from a mortgage banking standpoint, it's more than just lining up the financing. It really is getting into the personality of the asset and the personality of the owner and the borrower and the sponsor, because our job is to get them money. And the real asset that the lenders on the panel are looking for, it's not just the sticks and bricks. It's also the expertise and experience of the sponsor and their ability to protect that asset. So, when we're recruiting in CBRE, I always like to make the distinction that I know you're recruiting or you're talking to the mortgage banking group, which is us, and you're probably going upstairs to talk to the investment sales group, which is them, but you really want to come work for mortgage banking. So, it's kind of that friendly competition that we have within the company, but I believe that's an important distinction.
I'm going to take exception to that.
Okay. All right.
Because I think, part of what you all in the audience may be missing really revolves around the nuances of our different positions and what we do in terms of mortgage banking, lending, underwriting, exactly what the subset of the world is. And I think when you cut through it, what we do, everybody on this panel, including our moderator, we sell money. That's really what it comes down to. So lending is a sales job. And first you have to sell yourself. First, the owner is selling you as a lender, saying, I have the best property, they're not making any more land, whatever cliches you want to think about. I need you to give me as much money as you can. And so the first thing that you do as a lender or a mortgage banker or an investment banker or an underwriter, whatever it happens to be, is you say, does this make sense? Can I sell it to myself? So first you have to get over it yourself, and you avoid the temptation. The hardest thing in this business is you realize that the person next to you is interested in it. And maybe you weren't interested in it, but if you know they're interested in it, you start thinking, I need to be interested in that. But you have to go beyond that, and you really have to figure out, does it make sense? And then you're selling your client, your owner, on why your money is greener than anybody else's. And so you have to figure out what distinguishes you. And sometimes, there are different products that you want to sell, but I do think it comes down to a sales opportunity. My getting into this business really had nothing to do with my father wasn't in the business or anything like that. I was interested in Latin American development. So it's a natural way to get into this, right? Which is that I looked around, I did study abroad, like I'm sure many of you have or will. I was actually in Colombia, in Bogota, and when I came back, I realized in order to do development work, you don't have to go abroad. There are so many opportunities in what we do. So that was how I ultimately ended up doing real estate lending, and again, it combines the desire to sell, the desire to compete, and the desire to win, but also an intellectual challenge of structuring deals so that first you can sell yourself, then you can sell your committee or whatever your approval process is, and simultaneously you're selling the ultimate user of that financing on why something makes sense. And if it doesn't make sense, you either say no, or you take steps, more importantly, to try to make it make sense. So I think, Jeff, my exception with you really was about the nuances of exactly what we do, because I think no matter what suit we wear or dress we wear or what we're thinking about, we're all trying to win and sell something.
That.
All right.
So to just kind of zone in on what each of us do, Daniel sells. I underwrite risk on deals. So he's trying to sell me on his deal, and me and my staff are trying to decide whether I'm buying what he's selling or not. So it goes to what Mike was saying, it goes to what Nancy and everybody was saying about the whole aspect of what this business is about. And from my perspective, what I find really interesting about this business is similar to what they're saying, in addition to being exposed to a lot of people from owners, managers, loan committees, making assessments, making risk assessments, being able to stand behind them and articulate them. You're talking to appraisers, you're talking to engineers, you're talking to environmentalists. Is this a sound piece of real estate, whether it's commercial, multifamily, whatever it is? So what's, to me, is the most fascinating about it is the whole aspect of it, from the financing to the bricks and sticks to the relationships. And my relationship with the salespeople, Daniel, it's a fine line because no one's in business to do no business. So you've got to find that way to make good risk assessments and good deals. And that's what I love about the business.
As much as it pains me, Jeff Day, you get the last word on this subject. Maybe.
Is there an exception?
I take exception to that. EJ and I used to work together, so he has every right to cast aspersions because most are probably accurate. Here's what I would tell you. I look at it a little bit differently. If I were sitting out there right now and considering real estate generally and financing specifically as a career, there are a few things that I would take into consideration. One is mission and purpose. What really turns you on? Because if you love what you do, you're going to be good at it, assuming certain minimum basic intrinsic skills. And I would assume because you're here, you probably have those. The second is the time horizon within which you're most effective. Some people are good in very, very short time horizons, and they want to have projects that they focus on or work on that they can get done in a day or 2 days or 3 days. Other people want to design the air conditioning system for the Dreamliner, which might take 7 years. In my situation, when I was picking a career, I realized that I wanted something relatively complex, but I wanted to have a unique and new project relatively frequently. And when you're in the financing space, deals that we do take 30 to 60 or 90 days. And I like to be able to start over fresh each time and have a new set of challenges, a new set of analytics, and an opportunity to create a different outcome each time. So that's something that you should consider. And then the other thing is I think you should consider your interpersonal communication and interactions and those types of skills which you're best at. If you're on the sales side, you probably have a high need to persuade. And as we were talking about earlier, there is this natural check and balance system in any risk management process in that the person that gets paid to put the money out is going to be pushing a lot harder than the person that gets paid to make sure that the money comes back at some point. Right? And so if you have a high need to persuade, then you're probably the person that wants to be on the front end that's convincing Patty to do the deal and convincing the client to work with you versus somebody else. Other people might have a real high need to be analytical and really figure out how the puzzle comes together and how the pieces fit together and understand every single aspect of that deal, and maybe that means you're on the other side. So it's important, and I think it's difficult, at least it was for me when I was in college, to be that introspective, but if you think through it from that perspective, it might give you a better handle on what component of real estate might be the best fit for you.
Thank you. So Patty, what's the coolest thing you've done professionally in the last year?
Okay, so I have 3 things.
Nope, just one.
Yeah, sorry. I'll go really fast. The absolute coolest thing I've done last, I haven't ridden a stagecoach yet, but I do have my picture in front of one from a trip I took to India to a group that we have there that's doing business for us. And it was a fantastic trip, great exposure. Loved it. A lot of business reasons for us to go that if anyone's interested in, we can talk later, but great experience. Another really fun thing that isn't necessarily really related to what I do, but I've been in this industry a long time and have made some great friends. And some of them are women that we have all grown together in this industry. And we did a charity event earlier this year that was a big success. Driven by us in this industry, and was a lot of fun, and it was great to be involved in that because of the network of women that I worked with. And then lastly, just recently was asked to be involved in a diversity council, a diversity and inclusion council that really opened my eyes to a commitment that we're very passionate about, and it was fun. So it was important to me to tell you a little bit about things that aren't every day in my job that we get exposed to on a much broader basis.
Nancy, how about you?
Working on a potential $100 million office portfolio that's located on an Army base.
Did you get the deal done?
It's not done yet.
It's not done yet. Oh. Is that going to be a life company? Or is that going to be a conduit?
It's either going to be a conduit or a bank.
A bank? Oh,
Balance sheet.
Okay. Well, since I'm asking you about it, obviously it's not us. Mr. McRoberts.
Yeah, so I think we mentioned that all of us are involved with financing for Fannie Mae and Freddie Mac. And as sure as everybody knows, Fannie Mae and Freddie Mac and our whole housing finance system is in disarray, or it's being contemplated to be in a different spot than where it had been historically. And Fannie Mae and Freddie Mac went into conservatorship in 2008, and I was there at Freddie, and I was there for several years after that. And a cool thing that I've been able to do since I left Freddie Mac is I've been able to get involved with Jamie and the other members of MBA and other trade groups, and talking to people on Capitol Hill about the housing finance system, and specifically how that relates to multifamily finance. Multifamily is about 10% of what Fannie and Freddie does. They typically, 90% of it is single family, but multifamily is important. And a lot of members of Congress don't understand that multifamily is a piece of what Freddie Mac and Fannie Mae do. So I've been involved, and Jamie and I actually last week were up on the Hill. We had an opportunity to sit in a room about this size with a few less people that were staffers of congresspeople and senators and talk to them about multifamily. And then after that, we had 2 private meetings with senators to talk about multifamily and talk about the housing finance system, and to hear from them what their thoughts were and kind of where the development is and where that's going. So that was pretty cool. Enjoyed that.
How about you, Dan?
For the last year, I would say that probably the most satisfying thing that I did is, as I said, I joined PNC about a year and a half ago, and we're an East Coast-based financial institution. Our agency business, again, that's the multifamily side, the Fannie and Freddie, was predominantly on the West Coast. So for the last year and a half, I've been hiring a bunch of people. We're full now, and so that was for that division. But one of the things that we did was we hired somebody from another firm to be an analyst for us. So the way that it works when we bring deals in, we have an origination side, as Patty said, we have an underwriting side, and then we have an asset management side. So that when really in that process, although there were overlaps along the way. So we brought somebody in as an analyst on the origination side, and he was very good and continues to show a lot of potential. And in June, after we actually were able to promote him to become an originator, so that he was working out on his own. And one of the things that did, I know that a lot of times when you're looking to go into a company and you try to figure out what they do, like I know a lot of people that went to graduate school at night, right? They did MBA programs at night, or they did master's degrees at night, and then they went to their company and said, "Guess what? I have a degree." And they say, "Oh, okay, congratulations. Where's that report that I was looking for," or whatever it happens to be. So a lot of times people feel that advancement sometimes has to come by leaving where you are. And so being able to promote this person internally was a very satisfying thing as a manager, because you're always looking to, it's very expensive to find talent, which is why, as you can see, we've got a lot of people that are here in the industry looking for you. But I think the more expensive thing is really retaining talent. And so when we have the opportunity to advance people, and I speak for everybody that's here, when we have the opportunity to advance people internally without them having to find a new job, find a new commute, work through benefits, do all that stuff, meet new people. If you have a fit and you can continue to grow with what you're doing, I think that's really the mark for you of the beginning of a successful career, if you can continually challenge yourself. So that was a success that I enjoyed this year.
Mr. Day?
Well, this is what you just said resonates with me, and my story is a derivative of that. We've hired 52 people in the last 12 months, and I think when you're a student, and rightfully so, even when you're first in business, you're more focused on your own successes and your own accomplishments. But when you get the kind of gray hair that EJ and I have, you start to be more appreciative and focused on the successes that you can contribute to around you. And we have a very robust training program. Clarence is one of our newest additions, or newer additions, and he's done a tremendous job. But don't tell him I said that, because I'm sure he'll come in tomorrow with a big head. No, he's been fantastic. But the most rewarding thing for me is to see the time and the money that we invest in training and advocacy and mentoring, and see these young people blossom and do a fantastic job and really regularly exceed expectations. And so the advice that I would give you relative to this whole topic is that it's important to pick the company that you work for and the person to whom you report as it is to pick a career, because that in your first 5 to 10 years will have as much or more impact on your success than what you're actually doing at the time.
Jeff, after that recruiting ad for Berkeley Point, what would you like to add?
Well, I thought about it when I saw kind of the list of questions, and seeing that I work for the big global CBRE company, we have a policy against doing anything cool. So I had to really kind of think about this one, but I would say that it's actually a new program that we've started in the company, and I'm happy to say that I'm a part of it. And we had the launch a couple of weeks ago, and it's a new mentor program that we started within the company. And to really challenge us, our mentees are outside of our lines of business, and they're actually outside of our local market area, and they're making us stretch into different lines of business and actually bring kind of our thoughts about the global big CBRE down to kind of a level of these individuals that have 2 to 5 years experience in the company, and they've been identified as being real thought leaders. But in a large company of 37,000 people worldwide, you can kind of get lost. So we're really focusing on this group of individuals to try to help steer them with their career. So if I get invited back for this next year, hopefully I can report that my mentee is now vying for the CEO position, or maybe my position, who knows. But that's just been real meaningful, because it is hard to recruit. I mean, it is hard to really bring people in. And so the more that we can do to help people advance in the company once they get in, it's rewarding to be able to put these kind of programs together.
Thank you. Anybody have any question that they want to ask the panel? Otherwise, you get stuck with our questions. We got one? Oh, right here, okay. Okay, great.
I would like to ask any of you guys, what do you think is the biggest difference between what your career was versus IB career, investment banking career, Wall Street?
Well, let me kick it off, because we have an investment bank in my company. I would say that one of there are a lot of similarities, certainly, I think, on the mortgage banking side, and I think the panel will address some of that. I started as a commercial banker, and I think the big difference for me is I think we focus more on a relationship with the client, and we come at it typically from a debt perspective as opposed to an equity perspective. A lot of investment bankers are paid to give advice around which oftentimes involves equity. I've been a lender my entire life, and for me, it's a different perspective because, the best thing that happens when you're a lender is you get repaid. But if you get repaid too soon, that's a bad thing, and if you don't get repaid, that's also a bad thing. So I find the biggest difference is just, I come at things from a debt perspective, and whereas my colleagues in the investment bank look at it more from an equity perspective. Nancy?
Yeah, I would agree with that. I'm going to add that, I've got a couple of nieces up in New York, so if you want to go that route, you're going to work major hours, and you may cover just one specific topic within the companies. You might just be doing equity raises on, energy or what have you. So I think all the firms are a little different, but I feel like it's a less tangible asset class that you're working on the investment banking side, and you're really working with companies rather than a property, real estate, tangible property. So I think that's kind of the biggest difference that I see.
I worked on the street for about 8 years when we were owned by Deutsche Bank and was exposed to a broad variety of capital markets and advisory executions. And I would tell you that the big philosophical difference, I think, for the most part, is that when you work on the street, everything's a trade. And it's about how much money you can make. And at least before 2007, you had pretty much unlimited upside and zero downside. You can't make less than zero. So if you had a really bad year, you just didn't get paid. I think that the people on this panel and EJ are in a different kind of business where there's a little bit more give and take, and there's a recognition that the last tick isn't going to make a difference in a given trade because you're going to have a long-term relationship, and sometimes the client gets a little bit better end of the deal, and sometimes you're going to get a little bit better end of the deal, but it's more of a relationship-oriented, I would say softer is probably not a fair way to characterize it, but a little bit more human existence than it is on the street.
Anybody else like to add to that?
I think the fact that we've all self-selected towards an industry, I mean, there's a nut of an answer right there, but I think you're talking about all the different nuances in the world of finance, right? There are lots of different ways that you can play on that, and I think one of the things that if you asked us all when we were beginning our careers where we were going to be 15, 20, 30 years from then, I don't think we would have been able to tell you really, other than just maybe a more generic, we're interested in finance, or we're interested in real estate and kind of what that means. And so I think investment banking is just another side of finance. So the question is, where do you want to play? Because we've all been talking about our favorable experiences on the lending side, on the mortgage banking side, on the structuring side. And so there are lots of different things. I mean, We talked earlier, Jeff talked earlier about having people that you report to and work for. I mean, I had the same boss 4 different times in a number of different jobs, and so that was really a big thing. And I would say that whether it's the person or some sector, I mean, there's something pretty interesting about working on housing from where we sit and reading about it in the paper every day today. And a lot of us focus on multifamily even as a subset of finance. So whether it's investment banking or project finance or structuring or debt side or equity side, there is a whole range of play. And it really, I think you're looking at the fundamentals of an institution and of the management and really what it allows you to do. Because when you go home every day, whatever time it is, what did you do that day and how did you feel about it? And I think that really is the determinant in whatever job you're looking for. And investment banking, I looked into when I was in business school and ended up moving more towards this side of the platform, but it wasn't any kind of indictment on that or anything like that. It was really just a choice, and I think it's no more and no less than that.
Anyone else have anything to add? Great question, thank you.
Investment banking.
So the question is, if he gets in the real estate business, what skills am I going to learn that I can transfer to some other occupation? Is that a fair? Okay.
Well, I would say the first thing you're going to learn are analytical skills, which you can take with you in any type of career. I think that, secondly, you also are going to learn negotiation skills and structuring skills, creativity, creative thinking, and how to get a deal done. So that's my favorite part of being on the production side is I actually have 2 clients, my real estate developer and my lender, and I have to make both of them happy. And in doing so, it involves a lot of negotiation, it involves a lot of thinking, right, what's the lender's problem or the developer's problem, and how can I solve that problem? So it's fun to figure out how to put that deal together. And in the end, I think those are skills you can take with you and use throughout the rest of your life.
I would just add the people skill part of it's very important as well. So no matter what discipline or what part of the business you're in, whether you're underwriting side or in the sales side, you really need to have the people skill and to be able to communicate. I think there are other industries where you may just go into a cubby hole and you're very analytical, or you're an engineer or you're an architect or something where you really focus in on something. That's great for a lot of people. But in our industry, I think the people skills, regardless of where you are, you really need to have them.
Yeah, what do you guys see the role of Fannie Freddie in
Looking at me.
Well, let me first say,
Well, they're not shut down today.
yeah, I would say, and I'm speaking personally, so I'm not speaking for KeyBank or mortgage bankers. I personally don't believe in the next, sometime over the next 5-7 years, they will exist in their current form. I just don't believe politically there is a will in the United States to put them back to where they were pre-crisis. Now, having said that, there is nothing to replace them today. And the, political situation here in Washington is so dysfunctional that, it's been 5 years that they've been in conservatorship, and we just now have a couple of bills being proposed. But I think ultimately they will be replaced, and they'll be replaced by things, entities that do very much the same thing that they do today.
And I think that the real question is, does the federal government play a role in whatever
Right.
they end up at the end
Right.
of the day? So are they going to participate? And my sense would be they really have to. The federal government has to play a role. If you think about the landscape, there was $63 billion of multifamily finance that Fannie and Freddie did in 2012, 63. The regulator is trying to incent private capital to come into that market, so they required the Fannie and Freddie to reduce their volume by 10% in 2013. So they're down to $57 billion, and they're talking about doing that again. that's still $50 billion is a lot of money last time I checked. That's a ton, and there isn't a source of capital out there that can make up that gap anytime quickly. And there's a lot of reasons we can talk after this about why the federal government should play a role and will play a role at some level. And I don't know if it's 30 billion, 40 billion, 50 billion, whatever the number is, but I think in our lifetime and for the foreseeable future, the federal government will play a role, and they'll be a viable source. Whether they're called Fannie and Freddie or they're called something else, there'll be a role for those type of companies.
I'll also add, I mean, if you put it into context, which you did, if in 2013 the allocation for multifamily, single property type for Freddie and Fannie is $57 billion, that pretty much is the entire allocation for the life insurance company business on an annual basis. So when you put it into the context of, yeah, we don't have 63 this year, we have 57, but that's a single property type. The $60 billion allocation for life insurance companies is all property types. So there's still a need for the capital in the marketplace, and I don't believe that either one of them is going to put out $1 less than what they're allowed to put out this year, and we'll see what happens in 2014. But I agree with you that there's still it's still a big part of our market, and will it be the same in 5 years? Personally, I can't speak for CBRE. I would agree with EJ, and I would agree with Mike that there's going to be a change. It's not going to look the way that it looks today, and it's anyone's guess as to what it ultimately is going to look like.
I do want to expand that slightly to remind everybody that the answers that this panel has just given really were focused on multifamily. But Fannie Mae and Freddie Mac, I mean, when you think of Fannie Mae and Freddie Mac, you think of home mortgages, single-family mortgages for houses. Okay, and when you look around, I don't even know what the numbers are that Fannie and Freddie are as part of that system, but this country really is in a very unique place with the long-term fixed rate 30-year mortgage that people have access to. Our home ownership rate is unlike anything you see in other parts of the world. Unfortunately, some of the downside of that is that the single-family business on Fannie Mae and Freddie Mac has lost money in challenging economic times. Multifamily, when you think about starting in 2008, multifamily didn't lose any money. And I think part of it is everybody thinks, what's going to happen to Fannie Mae? So the answer we want to give you is about the multifamily side, but there's a whole part of it, and so obviously there's an implicit subsidy and now a more direct subsidy that relates to Fannie Mae and Freddie Mac. But what it means is that housing, whether it's ownership or rental housing, is more affordable to people, and that's the ultimate goal. And so there have been questions about, well, should their mission be focused more on affordable housing, that it's affordable to people earning at area median income or below that, or should it be really focused on even more affordable than that? But I think we're all scratching our heads as we look at the headlines today, thinking, all right, so how is the Congress going to have a will to get together to actually work through reforming? I think that's probably a longer-term challenge, but the issue is, what should the role of the federal government be, and how deeply should it go? But don't lose sight of the fact that you've got single-family and multifamily.
No, and single family is going to drive the argument, right? Because Fannie and Freddie combined have in excess of $6 trillion worth of single-family exposure. And what a lot of people don't understand is that many global investors buy GSE securities as a proxy for U.S. Treasuries to get a little extra spread. And if you took, and I'll debate the multifamily thing, there's enough liquidity out there to fill the gap for multifamily. That's a question of clearing price, not liquidity. There literally is not enough liquidity in the global fixed income or financial markets to replace Fannie and Freddie absent that guarantee. So at the end of the day, it threatens our survival as a country in the sense that we have developed as one of our cornerstones and one of the significant factors that stabilizes our society as home ownership. And without Fannie and Freddie, it's just not going to exist. So in the same form, and that transition would be unbelievably painful. So, I think all of us from a consensus view, even though there might be a little bit of a difference of opinion about some of the drivers, is that they can't afford not to exist, but they'll probably change the name because everybody finds Fannie and Freddie, in terms of labels, offensive names these days. There has to be a guarantee.
And I'm just going to add, similar to what Daniel was saying, was just to kind of drive the point home on the multifamily side, incredibly successful on the multifamily side, very little losses over there, and really a gold standard for how to lend on multifamily business. Admittedly, over the last 10 years, it's been a dynamic market for multifamily. The demand is amazing. We had a little bit of a blip during the financial crisis, but it's come back very strong. But whatever happens over the next 5 or 10 years, their underwriting standards will really set, hopefully, where this goes. At least I hope that they really use that as a model, because it's been very, very successful, and for the industries to build off of that.
And you'll do a lot of finance through that carry program at Hopkins. But the debt load on a office building or on a commercial real estate property, the debt expense is usually, can be up to 60% of total expenses in a property. So when you can fix that piece of your expense load on a commercial real estate property, then you can, predict your cash flow much better. And so if you're on the development side, you're going to be putting together project costs and pro formas, and you have to take that into account as to whether that property can be affordable, and in order to make a profit. And it can't do it if it can't carry a reasonable debt expense, mortgage payments.
Yeah, I'd just add that real estate, of all assets, all sectors, real estate's the most highly leveraged sector. And Nancy's right. It's debt plays a huge part in the feasibility of a particular deal.
Add that probably all of us have seen the absolute best development deal put in front of us. It just can't get financed. I mean, literally. I mean, that's how important the whole finance and capital side of development is, because great piece of dirt, great developer, great plan, but then you start looking at it from a finance in the standpoint of will this work once the building is completed, and you got to say, we can't get it done. So I think it's one of the most important pieces of development.
Yep. It's the Jerry Maguire theory. Show me the money.
Any other questions?
Hi, good evening. My name is Tom from Caribbean School, Johns Hopkins. I'm taking a class, and the professor divided the whole class into several groups. Some are investment banking, some are lenders, and some are companies. So I'm here to ask your opinions. If you are one of the lenders, how do you get the best deal to be the winner?
Interesting.
How are you evaluated? Is it based on returns?
So you can evaluate?
Well, when you say best, how do we define best?
Okay, so the rule is you have to compete with your lender peers and the investment banking. So you'll get the best deal, means you will get the highest interest on your investment.
Without regard for risk? If risk does not play into this, I have a few thoughts for you after the class.
Go ahead.
I was just saying, my response is you hire an intermediary like Northmark or CBRE. And that's how we make sure that you get the best deal from the lender. But that's.
Well, our time is up. I want to thank the panel. You guys did a great job. And I want to thank you all, the audience, for your questions.